Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, today we're taking a deep dive into the U.S. market analysis for Wednesday, April 8th, 2026.
This video presents a direct informational narration of the source document.
So here's how we're going to break things down. We've got four main parts to walk through. First up, we'll look at the initial market shock and the system flows behind it. Then we'll get into the bigger picture with geopolitics and the Fed's posture. After that, things get interesting with some clashing views and strange trades. And we'll wrap it all up with a look at rotation, a summary, and the outlook.
And of course, the important notice before we begin, this document is for informational purposes only and is not investment advice. Please remember that investing involves significant risk.
All right, let's jump right in with our first section, market shock and system flows. We're going to unpack the market's immediate reaction to the big news and see what's really going on with those automated strategies working behind the scenes.
So, the market gets hit with this bombshell news, right? A temporary ceasefire agreement. And boom, the S&P 500 gaps up, opening at 6754. You had this initial wave of buying, this emotional push that carried it all the way up to an intraday high of 6793. But, and this is the really critical part, it stalled out right before that big psychological level of 6800. And then it gave it all back. The entire move just vanished.
So what does that price action actually tell us? Well, it's a huge clue about investor psychology. This complete reversal points to a classic sell the fact scenario. You know, the headline was good, but the risk premium, it didn't really budge. That tells you the market's excitement was incredibly shallow. There was just no real durable support underneath it all.
So you might be asking, with that kind of reversal, why didn't the market just completely fall apart? Well, a big part of the answer is systematic flows. You see, these automated funds, the CTAs, were sitting on a massive short position. We're talking $45 billion worth. When the market bounced today, their algorithms were triggered to start buying back those shorts, and that injected about $20 billion of pure buying pressure right into the futures market.
So what's the actual trigger for all this automated buying? Well, the models are basically programmed to buy as long as the S&P 500 stays above that key pivot zone between 6740 and 6750. This creates a really interesting dynamic, something the source calls dragging but not lifting. It's a great way to put it. It's not an engine that can push the market to new highs. It's more like a safety net that just keeps it from collapsing.
And that actually brings us perfectly to our next section, geopolitics and the Fed's posture. Because you can't understand these market moves without looking at the bigger picture, just how fragile this piece really is and how that's tying the Federal Reserve's hands.
Look, it is absolutely critical to understand that this ceasefire, it's just a pause. It is not the end of the conflict. The risks are still sky high. I mean, this agreement is basically just a 2-week extension. At the same time, you've got shipping lanes in the Strait of Hormuz in chaos, and there are new tariff threats floating around. And if you want proof that the smart money knows this, just look at the VIX futures, the fear gauge. It's rebounding, which means people are already putting their hedges back on.
And this really gets to the heart of the matter. There's a great line in the source that says, when flow through the energy corridor becomes the only real measure of peace, diplomatic language looks hollow in front of live fire. I mean, that says it all, right? It's this fragility, this on-the-ground reality that's forcing the Fed to be so cautious.
So the Fed is basically stuck. They're working with what the source calls a dual-track logic. Think of it like two different paths. Path 1 is the rate hike threat. If that Strait of Hormuz gets blocked and oil spikes, creating more inflation, you better believe the Fed is ready to hike again. Path 2, the one that leads to rate cuts, well, that door only opens if inflation is clearly heading down and all this geopolitical risk disappears. It's kind of wild when you think about it. U.S. monetary policy is essentially being dictated by who controls the sea lanes in the Middle East.
All this uncertainty, as you can imagine, is leading to some major disagreements. And that brings us to Section 3, clashing views and strange trades. Wall Street is completely divided on what to do next. And at the same time, we're seeing some, let's just say, very unusual activity in the markets.
And you can see this clash of the titans right here. On one side, you have JP Morgan. They're tactically bullish, they see a path to 7,000, and they're telling clients to add risk. On the other side, you've got Goldman Sachs. They're saying not so fast. They advise selling into this strength, pointing to that heavy resistance between 6,800 and 6,980. So what's the difference? Well, JP Morgan is really focused on the technical buying from those CTAs we talked about. Goldman, though, is looking at the fundamentals, worrying about what high oil prices will do to company earnings. It's a classic battle, technicals versus fundamentals.
But okay, beyond the big banks arguing, there's this other story that's kind of wild. Check this out. The day before the ceasefire was announced, some anonymous trader goes and spends $12 million on a huge, very specific bet on S&P call options. The next day, after the news hits, that position is suddenly worth $35 million. That's a $23 million paper profit literally overnight. I mean, you don't have to be a conspiracy theorist to see that kind of timing. Raises some serious questions about who knew what and when they knew it.
Okay, so with all of this going on, let's pull it all together in our final section: rotation, summary, and outlook. We're going to look at the massive shifts happening just beneath the surface of the market and then give you the key technical levels everyone on Wall Street is watching right now.
One of the biggest stories inside the market right now is this massive pair trade. You've got hedge funds going long semiconductors and shorting traditional software. We saw a really violent split today, with software getting hammered while semis just soared. The whole idea behind it is that AI infrastructure, which runs on semis, is going to completely disrupt the old software business model. But here's the catch. This is now a very crowded trade, and it's loaded with leverage.
So when it's all said and done, what are the actual levels to watch? Here's the bottom line. Your main defensive line is 65.50. If we break below that, you could see a really fast sell-off. To the upside, the big wall of resistance is still that 6,800 to 6,980 zone we talked about. For this to be a real, sustainable reversal, we need to see the market get above 6,980 and stay there. That's what would open the door to new highs.
And that really brings us to the main takeaway, the core strategic advice from the source. We're in what it calls a macro fog, right? Headlines are flying, some people seem to know things others don't. And in this kind of environment, disciplined caution is rule number one for survival. The smartest thing to do is just be an intelligent follower. Watch those key levels we just laid out, and whatever you do, avoid overtrading while you're stuck inside this fog.
And to wrap up, one final professional risk disclosure. This document does not constitute investment, financial, or trading advice. Any investment decision you make is undertaken solely at your own risk. It is your responsibility to conduct your own independent research and to determine if any strategy is right for your own personal financial situation.